Thank you, Lauren. Welcome everyone to CPO Australia's webinar, Path to Finance Resilience through Collaborative Planning, sponsored by JEDOX. My name is Ram Subramanian, as Lauren said, and I'm the Senior Manager Reporting Policy at CPO Australia. We have people joining us from all over the country for today's webinar. Firstly, I would like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present, and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. It is now my pleasure today to introduce Peter Metcalf, our first speaker today. Peter Metcalf is a partner at Oliver White Asia Pacific. Before I hand over to Peter, as Lauren said, today we'll be taking questions through the Q&A box, so please direct questions to all panelists. We will address questions at the conclusion, and we will do our best with the time remaining in answering your questions. As Lauren said, for any troubleshooting queries, please send a message to the host, which is Lauren, using the chat box. It is now time for our session to come in, so I will hand over to Peter. Peter, over to you.
Thank you, Ram, and hello everyone. It's a pleasure to be here today to share my thoughts with you. I'm delighted to be talking about this topic, the path to finance resilience through collaborative planning. My organisation works with many companies over the last 5 decades, and the topic itself really resonates with us in terms of our passion towards trying to get organisations to integrate and to collaborate. So, as I say, hopefully some of my thoughts and concepts that I will present today will resonate and be applicable in your environment. The last 12 to 18 months has certainly tested everybody's resilience and patience. I think, we've been through an environment that is just so unusual and so new to everybody. And those organisations that are well structured and well planned and well organised have probably been in a better position to actually address a lot of the challenges and issues that they've been faced with, whereas those that are less structured, less organised, probably have suffered more than others. We know that some have benefited from the current situation and some that have suffered a lot. So as I say, the concepts today, hopefully they will help you. What we've learned over the last 12 months or so is that a few interesting aspects is that this definitely is business unusual. We've never really seen anything like that, this situation in our lifetime, and so we're continually coming up against different situations that we're trying to attack and remedy. And so it definitely is business unusual. But what we have found is that integration still matters. So as I said earlier, if the organisation is well structured and the functions within the business are communicating well with each other, and we've got the plans in place to help us achieve our objectives, we then have a base which we can work against to actually assist us in attacking any issues or any threats that are coming our way. Most of you would realise probably that business plans are built on a solid base of assumptions, and now more than ever, our key assumptions, understanding them, is really so important. I mean, assumptions are our predictions of what we think the future would like. So if we go back to the beginning of 2020 or late 2019, our predictions of what the future would look like would have been totally different to what has actually materialized. So having those assumptions is really important, and having them as a reference point as we try and become more resilient is really critical. Reacting and responding are very different. So some organizations are always in reactive mode. Something happens and it's totally unexpected, and so they have to react, and they're basically in crisis and they're firefighting. Whereas other organizations that are well organized typically are anticipating what may happen in the future, and so they have responsive plans already in place. And that's really the essence of what I want to talk about today, is how do we take the plans we have in place, try and identify any risk or vulnerability in them, and then prepare ourselves. The next point is really critical. I think that scenario planning is just as important as budgeting. I know as an accounting and finance team that are joining us here today on this webinar, you would obviously be very focused in your day-to-day lives, maybe on budgeting and keeping track of the numbers. But scenario planning, in our view, is just as important as budgeting. So, you know, the budget is one prediction of the future, but scenario planning in terms of predicting different futures is really critical. We'll talk more about that too. Simulation and modeling, we found a better predictive mechanisms of people. People are obviously very important, and we need people to be doing the modeling and the simulation. But if you've got good systems in place that have good, rich data, and you have the algorithms built into those models, well, then you're in a great position to be able to try and simulate different futures. The next 2 points are very emotional aspects of what happened last year. Obviously, there was a lot of anxiety. So when there's anxiety, there's worry. When there's worry, we can't think clearly. And when we can't think clearly, we can't come up with solutions. So we can't be creative. So if we can put ourselves in an environment where we can start to create some positivity, well, then we can get more creative in terms of focusing on solution mode instead of problem mode. And so this concept of collaboration and being with people and cross-functional collaboration, particularly within organizations, but also in your own personal lives, collaborating with people to come up with solutions to your problems is certainly something that will stand you in good stead. And then the last point, I'm quoting a couple of abbreviations here. I hope some of you might understand them: S&OP and IBP. S&OP is Sales and Operations Planning. IBP is Integrated Business Planning. If you have these processes already in place, don't throw them away. Keep them in place, because these are the processes that will stand you in good stead. Our organisation, Oliver White, has traditionally worked with manufacturing companies, fast-moving consumer goods companies, consumer product companies, etc., etc. So if there's any of you on the call that are not related to those industries, please bear with me. I think some of the concepts I'll talk to you about will still be relevant to you. And it's on this latter process, integrated business planning, that I'd like to really focus the presentation today, and start with a really simple concept on the fundamentals of business. And this is really synthesizing it down to say there's these 3 important aspects to any organization. We plan, we execute, and we monitor. And it's a perpetual cycle. So we keep planning, we keep executing, we keep monitoring. What we find is that most people like to operate in this bottom segment, executing. People love to do things. The planning piece maybe comes around once a year, strategic planning, budgeting, and nobody really likes to be monitored. You know, the tracking of performance is something that we find in organizations. People do, often because they have to, but they're really not that interested in it. But in reality, these 3 components actually are critical for us to be able to build a resilient business, and A, to be able to plan the future, and then B, to be able to anticipate maybe different outcomes based on the fact that the business environment is very dynamic. And so a more detailed version of that particular model is this model here, and this is something that we've built over the years at Oliver White. It's called our integrated business model. And it's basically built on the premise that all organizations should have a strategic plan, maybe looking at 5 or 10 years. They should have a business plan, and they should have decided what success looks like through key performance indicators. And then what we've also found, and it's a common denominator really across all organizations, is that they all have things in common, in that they all have product portfolios or product and service portfolios that they have to decide on strategically. What products and or services do we take to the market? And they have to have processes to support product management and portfolio management. They have to generate demand for those products and services. So we have to have marketing activities and selling activities, demand generating activities, and we have to supply those. So we either internally source or we externally source, and we have to have relationships with third-party suppliers, etc. We have to have warehousing and logistics capability. So essentially, there are 3 core process areas within any organization: product management, demand management, and supply chain management. all of them being led and directed by the leadership team, the executive team, who have the responsibility for setting the strategy and the execution of the business and giving direction in terms of these three key areas. Of course, we need a business supported by good people with strong values, a passion for learning from the past and knowledge management, an overarching view towards continually improving, and throughout all of this, a strong view on financial appraisal. So we're in business to make money, but we need money to make money. So have we got our finance team within the organisation truly locked into all of these elements of strategy, product demand and supply on a continual basis? And it's this area at the top that I've marked in green that I really want to focus on, because that's really the essence of the business. When you talk about financial resilience and collaborative planning, it really is the executive team's responsibility to actually ensure that the whole organisation is connected together. And so out of this, we have a process called, I'll just go back here to this slide because it's come through in more of a PDF version. So we, as an executive team, we need to ensure that if we put a strategy in place, that strategy is being deployed. And there are specific executives within the organisation who are responsible for the product portfolio, for sales and marketing through demand and also supply. And so if I'm the CEO of the business, I need to know on a regular basis, and we would describe that as on a monthly basis, we want to know how we're performing in that regard. And also I need to know, are we still confident about the future? And so if we put a strategic or a business plan in place, are we still confident about the assumptions sitting behind that plan? And if we are, great. If we're not, well then what's the deviation that we're anticipating may come from that? So we would have seen last year, if we were sitting in March last year, we would be having discussions in our management team with a cross-functional group of saying, well, actually, no, we're not confident of what we think we can achieve in the future. And so we have a series of monthly meetings, product review, demand review, supply review. We pull it all together in what we call a reconciliation review, and then that leads to a management business review where we're talking about the overall business. And from a finance perspective, it's obviously really critical that, as I say, we're in business to make money. We need money to make money. So the finance team needs to be our business partners and working with us. The process itself, as we've learned with organisations, is it has to be executive led. The CEO and the leadership team have to own this process, and they have to play a key role. They are ultimately accountable for delivering the business results. It's aggregate planning, so it's done at a higher level. It's not SKU. It's on a rolling horizon. So we move out of the budgeting year, and we utilise a concept called roughly right versus precisely wrong. So we know that whatever we're forecasting for next year and the year after is based on what's happened in the past and any assumptions we might have on different market conditions. And so we know that it won't be exactly right. So this concept of not getting down to the granular detail is really critical. And as I've said, we need finance support, because in each of these areas, product management, demand, supply, and then total business, we need to get a feel as to what the organisation, the health of the organisation looks like financially. And if we're to have financial resilience, we need to know that any changes we make to our plan, to the outcome, is going to affect us financially. And to do this, we need some key planning roles. So from a process perspective, I've talked about these three core areas of product demand and supply. So we need planning managers supporting the senior executives, and we also need somebody supporting the CEO or the managing director in this integrated business planning role. And we also need key finance business partners covering corporate finance or financial control, and then business partners in marketing, commercial operations who are working very close with their business colleagues who are responsible delivering the results, to ensure that they have robust plans in place, not only from a volume perspective, but a revenue and and expenses and profit perspective. So a really critical element of this financial resilience and collaboration is to have these core roles within the business and to work as a team. And so if we can gather all of these elements together, product, demand, supply, the budget, the finance, and the strategic planning, and put them all together like a jigsaw, then in that integrated collaborative fashion, we've got a much better chance of delivering the total value that the business is expecting. If we have any weak links within any of these aspects, well, then of course the business is going to suffer to the degree that you have the weakness in those links. I mentioned strategy. And so a lot of organizations have a 5 or 10-year strategic plan, and ideally they would then break that down into very specific roadmaps and then into a 3-year tactical program or a business plan. And then of course everybody has a 1-year budget. And what we find is a lot of organizations do this strategic planning maybe annually, sometimes maybe not even annually, and then very quickly drop down to the 1-year budget, and their focus becomes wholly and solely on that 1-year objective, and they tend to lose sight of their overall strategic plans. Now, if you're to build resilience in your business, in our experience, you need to be looking beyond the current financial year. You need to be looking out into year 2 and year 3, because some of these programs you'll work that you're expecting to materialize in year 2 and 3 are actually being worked on in the present. And so a concept that we've developed of a rolling 24 to 36 month rolling plan that you're reviewing every month, you're reviewing at a segment level, you're really only focusing on change. So if we've got new information that suggests we should change the plan, we do. If there's no new information, don't change it. And as I say, we do it monthly. We look at volume, value, and resources, both people and money. So do we have enough in place to achieve our objectives, and we do it over product, demand, and supply. And the critical question always comes up, well, how far into the future do we look? As I say, a lot of organizations focus on the annual plan, but really we want to move out into a rolling 18, 24, 36 month horizon. And the question for you to ask yourself is, what is a typical lead time for us to be initiating any strategic initiatives or to be able to respond? So take the COVID environment. If you had to change suppliers from one country to another country, how long does that take you to do? If you have to build a new factory or a new warehouse, how long does that take you to accomplish? If you need to launch a new product. So the horizon that you're looking at is judged on those lead times of critical elements. Another important aspect is, if we put this strategic plan in place, don't set and forget it. Let's bring it to life. So let's review, let's reconcile against it every month. So what do we reconcile it against? Well, hopefully this strategy has got clarity in it, and we've communicated it down through the organization. But on a month-to-month basis, we want the people that are executing the plan to actually be informing us about what the real market conditions are. So remember, at a point in time, the strategy is a scenario that we have chosen, and we've agreed on that. But as we know, market conditions change, so it behoves us to be diligent in picking up market condition changes and accessing that information from people within the organisation to get this bottom-up view, and then comparing the two. And if we've got any gaps financially or strategically, well, then as an executive team, it's incumbent on us to be addressing those particular gaps. I mentioned earlier that we should be planning at the aggregate before the detail. You only need the detail at a particular point in time. And so focus your 12, 18, 24, 36 month planning discussions around the aggregate. One of the things we've learned over the years is this statement here in the red box: no amount of planning at the detail will make up for an error at the aggregate level. We always get a more accurate plan, an estimate of the future, by working at aggregate. So don't bog yourself down in the detail. We also need a formal structure within the organisation in terms of who's responsible for what, and what's the cadence of reviewing the plans, and at what level of granularity. So I've mentioned that this integrated business planning process is the responsibility of the leadership team and the senior managers. So it's up to them to be monitoring and tracking the performance of the organization, but looking out there in the future. They're in the helicopter, if you like, they're on the bridge of the ship, they're looking out and trying to anticipate any danger or any opportunity. And from a strategic and financial perspective, they're making decisions about what needs to be done out there in the future. Those decisions are then cascaded down through the organization to the middle management team, who are actually executing the plans, and so they're operating within a shorter time frame. They might be operating within the next 2 to 3 months, so they need to meet on a weekly basis and talk about any deviations within planning. So during this COVID-19 situation, you would have seen a lot of discussion going on in these weekly planning meetings. We also tend to see leadership team members dropping down into these middle management meetings because they feel the need to be controlling and be given some confidence that the business is operating the way it should be. And then, of course, we move right down to the detail into scheduling. One of the critical elements of any plan, be it strategic or business plan, is the focus on assumptions. So assumptions are the thinking behind the numbers. So when we're building our strategic plan, business plan, we're obviously predicting the future, the economy, the industry, market conditions, competitor activity, and it's that thinking that we've put in place that actually could become an area of vulnerability or opportunity. So once again, at any point in time, we have to choose where we think we'll be, whether it's the strategic plan or the budget. We have to choose a scenario, and so that is this grey line here, the most likely outcome. But of course, because that's underpinned by assumptions, we could have some upside and we could have some downside. So we have to be talking about those opportunities and vulnerabilities that are not short-term opportunity and vulnerabilities, but they're medium to long-term. They're out over that 24 to 36-month planning horizon. And importantly, on a monthly basis, we should be discussing them and talking about what can we do to capitalize on the opportunities or mitigate the vulnerabilities. And hand in hand with that goes the overall management of risk within the organization, so the business continuity. And so how do we bundle vulnerabilities, opportunities, and risk management together so that we can be building scenarios for the organization and contingency plans so that if something like COVID does happen, we've already given it some thought, we've already got a plan B or a plan C sitting there in the sidelines ready for us to respond instead of us reacting because we didn't anticipate it in the first place. And so, as I said earlier, scenario planning is as important as budgeting. So on a formal basis, and we would like to think monthly, if you're running this integrated business planning process, the senior executives shouldn't be focused so much on the short-term detail. They should be confident that the organization can deliver that. But if you want to build some resilience in your business through a collaborative effort of the executives working together, you are addressing these vulnerabilities and opportunities that have been identified, and you're also asking this critical what-if question, which links back to the risk management within the business. So what happens if we run out of money? What happens if interest rates go up? What happens if something happens in the environment? What happens if the government makes some changes, et cetera, et cetera? So you're continually having these discussions and putting contingency plans in place. The modelling of those then requires us to have a formal scenario planning process in place. Lot to talk about here, and I'm not going to go into any details. So hopefully I've given you an overview and some sense as to how we would approach business in terms of collaborative planning, and through that collaborative planning and discussions on a regular basis, building some resilience to the business right across the business in a cross-functional manner. It might sound straightforward, but it's not simple. And of course, we all know there's complexity within a business. And I think that complexity within the business in today's day and age needs to be managed by people, needs to be managed by process, and also needs to be managed by tools. And so I'd like now to hand over to Jitu from JEDOX, and he'll take you through a demonstration of the JEDOX software in terms of how it can complement this particular aspect of the business. Thank you.
Thank you, Peter. That was very insightful, telling us how, from your perspective, how businesses can do collaborative planning in this time, and bring in resilience in a decision-making process, right? So what I would like to do now is to firstly start off by sharing my screen and talk about basically trying to connect the dots with whatever Peter spoke of, and try to use that here in the session. And what I'm doing is showing you how technology enables that process that Peter spoke of. And for that, I've taken an example here. So you see on my screen, we're talking about a company called BikerBest. They're a global biking manufacturing company who does retail across the entire world as well. They have multiple currencies, and we look at their process itself. So Peter spoke about three main processes as part of any decision-making process. We're constantly planning, executing, and then we need to monitor it. And that's the process.
Sorry, Jitu, to interrupt. We can't still see a screen.
So,
Awesome. Yep.
yeah, I'm not sure why that happened. I stopped and reshare again. Is it okay now?
Yes, I can see it. Yeah.
All right. Sorry about that. So let me quickly walk through that again. So basically, we're looking at an example here, which is BikerBest, which is a global bike manufacturing retail company. And we're looking at that process, right? So as Peter said, plan, execute, monitor, and that's the process we're trying to reflect here. We'll start off with strategy and how that would then tie into the business side of operations, sales, HR, IT, which all ties back into finance, because finance is the gatekeeper. And especially with the new external planning analysis, finance is across this entire business partnering exercise anyway. And we're looking at that from a high-level plan to more detailed 3-year plan at a high level again, but 3 years of tactical plan. From that, you can then go into, say, a year of budget, and then constantly do your rolling forecast, which could be 18, 24, 36. And you can see how a system, whether it's JEDOX or any other system, which in this space would be able to help you out there. And then this all ties into the monitoring piece, which is your management dashboards, your reporting, your consolidated reports. If you have multiple groups and multiple entities within your group and currencies and stuff, the ability to do what if simulations and scenario planning, as Peter rightly pointed out. And this also should tie into the risk management monitoring piece, again a piece that he spoke of. And we'll see all these things working together in a system, right? So I'll start off with the strategic planning piece quickly. So what you will see on your screen, and I'll enhance this a little bit bigger so that probably that makes things easier for everyone to see. And move some of this thing on top. And you're seeing basically BikerBest as an organization. I'm doing a high-level strategy plan here. The executive team is coming together and saying, hey, you know what? We need to plan, say, 3 to 5 years, but you need to look at different business initiatives and how those initiatives will affect our business in the term. So we're looking at this case here where we have different opportunities. We can also add new initiatives. In this case, let me say I want to add a new one here and say, hey, I want to say there's a new opportunity here. And so I could say, we're going to have a new new office, right? So we're going to have a new office in Australia. Reason why is the business is expanding, and we also see a lot more opportunity for the bikes here, especially with COVID. People are starting to be more conscious about their health. Maybe the bikes which you can use, exercise bikes. So we could probably sell that. So having an office is important. You can then go into planning around in terms of details, saying how much of revenue this will bring us. So you can actually plan around those areas. So I can actually say, hey, you know what, this is going to bring me about 3 million of revenue this year. And then we look at the expenses part. So we can say, hey, admin expenses is going to be $1 million this year. And all this will then tie into my profit and loss. And this would then immediately reflect across my bottom half as well. So you can see the 3 million coming across into my opportunities. I can then plan across different scenarios, whether it's strategic, best or worst. So in this case, I can say, hey, I have some risks. What if these risks come into play? How will that affect my bottom line? You can actually have that effect on the system, immediately reflecting for you, and you can actually play around with it for different scenarios as well as part of your strategic plan. So I've established my strategic plan. I have my high level information. I can use that to then start off my planning process, which could be at the 3-year level. So I'll actually focus on the sales to start off with and looking at the tactical plan for that. So I'll go into to that. So what you will see here is I'm looking at my gross revenue. Again, Peter spoke about staying high level. So we stay high level. Of course, if you need to go into further details or even apply the lower level, that's possible. Again, that ties back to your business. But in respect to this, you can actually see, I'm looking at my gross revenue, at my gross margin. I can change these numbers. I can say apply a certain percentage and see that effect taking place and how that will impact my overall profit. And I can have this high 3-year plan in place right there for me to kind of set this across. Now with that, I can then go into my regular budget planning. And for that, I would take an example, especially as we are sitting here with the people from finance and office of finance. This will be an apt example around how a cost center planning process will work. And this is to relate that to the budgeting. So again, my Backers business has several cost centers, and you can see all those cost centers here. And I'm starting that. In order to start that process, I would like you to bring it to this screen, which is called Status Monitor, and I feel it's an apt one. Me, myself, having been part of the Office of Finance, I've worked with them in my past life. And what we always saw is that, you have each of these cost centers, you're probably doing those processes in Excel, and you have different Excel sheets, and everybody enters into the Excel, pass it back to the group finance, who then collects those files, starts to collate all of them together. Very tiring, cumbersome process, and you're also not looking at a single version of it. What you could replace that with a system, which will enable, automate, and streamline that business process that you already have, something like this, where everything can be seen by the group finance at one glance here, and start that process by also introducing the concept of workflow, which will improve auditable chain traceability and ensure that single version of truth concept. So here, what we can do is say we start off with a top-down adjustment, and for this we need to have a baseline, right, to start our budgeting process. So you can have actual as your baseline, or it could be forecast, it could be 2 years past, it doesn't matter. In this example, we're actually using previous year data, and you can see I can just copy that over easily. I can also apply maybe a 5% top-down adjustment, and that will get reflected here. So as part of my workflow process, I can then say, hey, you know what? I will start my workflow process. What this will do, it will send out emails to all of the cost centers. They will then be able to go into the system and start entering the information. And this, as you can see, is a single level of workflow. You can have multiple levels of workflow if you want to. So in this case, the cost center submitter will submit it for the order that reviews it, either by rejecting it for you to revise it or approves it and then completes that cycle of the process. Now, as I'm admin, I can see all my cost centers here, but if I was the individual ones, of course, I will only see my relevant cost center, and security can be applied to the lowest possible level, which is at the account level as well. So now I'm going to assume I'm one of these people. I'm going to assume I'm in IT department. I'm going to plan as an IT department person. So when I go in there, I can actually look at all my cost elements. Here in this case, I have my personal expenses, my admin cost. I can actually go down into a lower level detail. Now, this will depend on your chart of accounts. It could be multiple levels as per your chart of accounts. This is just an example for the by the best scenario. So as you can see here, I have my baseline numbers already provided. I can then continue planning based on this and say, hey, I can apply, increase, reduce, and stuff like that. I can, before that, what I would like to do is to make sure I want to lock or hold my salaries and wages. I don't want my salaries and wages to change in this case, so I can use some functionality within the tool to hold this number. Now I would like to plan further from here, so I can use the drop-down box, or I can use what we have is called a planning assistant, which gives you a wizard-like option in here for you to apply different data entry stuff, which makes your data entry process much more simpler. So you can see flashing is the one we can just put an absolute number here, or you can actually put a percentage, reduce it or increase it. So I can say I can just want to put 2% here and apply that onto that, and 2% will get applied here. But you see my salaries has not changed because I put a lock on it. Now you need to have accountability to that hold, which has been placed. So you can go to the hold manager, and I can see that hold has been applied here. I can actually then release that hold, so I can continue doing more. But at least you can see there's a traceability to what you're doing. So somebody knows why this hold has been applied, because you can see it's done by this user, which is me, Jitu, and that's the time stamp, and that auditability is there to be seen. So now I can release this, say okay, and I can continue my process. I can also do commentary on at the individual levels. So I can put a number at the top level, or I can change numbers at a lower level, right? So I can still go in and now change this number. Say I want to change this to 35K, I can just change it at the base level as well, because I did the release. Now I finished my data entry process. This when I introduce the concept of workflow again, and I will go in there and say, hey, I finished my process. So I say, all good, and I've completed this stuff, and I can then click on proceed to then send this over to my call center owner, who now is able to review it. So now you see the activity is a review, and then I can basically put in a comment. As I'm assuming I'm also the call center owner in this case, I can then reject this or approve it. To simplify the process in this case, I will approve it. And immediately what I can also do is to actually show you that there is a history there, right? So you can see what each process was, when was it done, by who. Of course, all of the stuff was done by me. You can see that. Otherwise, you'd have seen the individual person's name there. So you know there's a auditability and traceability of the process. There's a date and timestamp, and the person's name. Once I close, two things happen. First, the data gets locked, so I cannot make any more changes. And you see that the status has now changed to approved. If I go back into my status monitor here, I'll immediately see that this has been completed, the IT department. The rest haven't. It's a live thing. As people enter the data, you can actually monitor this, and then you can send in reminders as well, streamlining and automating that budgeting process. Now, as we continue from here, we continue from our budgeting process, we can move over to a forecasting process. Now, instead of doing a simple forecast, I'd like to introduce the concept of using predictive in here. So what you're going to see in front of your screen is basically the microbest group, and we are looking at the units and to do a time series prediction. So I've already done the prediction in this case to save us some time, but I'd like to explain what is the system basically doing. So it's looked at the historical data, and then it's doing the prediction for me for the rest of the year. April, December, Jan to March was actuals. So it looks at several algorithms. Now, do I need to know them? No. So I may know a few. A system will run each of those algorithms and then which tell me which is the best fit for this data set. So in this case, the best fit for this data set is the exponential smoothing, and it's showing me that information. One more thing to note in here is to actually say, hey, you know what? The system is also learning. So as actual data comes in, it will learn from your data set. It will improve your forecast accuracy and reduce your error ratio. And that's what happens, and it continues. And leveraging on Azure's machine learning capabilities, it's actually constantly learning, and it continues that process, giving you a better forecast in time. Now, of course, you have the ability to also do minor adjustments, because there's nothing like human intervention, because this is a good mix of machine and human intelligence coming together, because there are factors that the machine may not be aware of, which you can apply. You can also have concept around driver-based prediction. As Peter also said, you may be different conditions that we're looking at. What if the system could help you on that? So here you can see an example where we're looking at a different internal parameters, but you could also have external parameters, right? Like what if there are public holidays? What if COVID hit, and maybe how will that affect my sales, for example? So different parameters will be used, and that's a different kind of prediction, and the system can enable you to do those kind of things as well. So from here, I'd like to proceed over to talk about something that Peter mentioned is having a ability to do rolling forecast, and that's important too, right? So you can have 18 months or 24 months, and you can continue doing that process. But what I like to highlight is that what you could actually do as an organization is that, hey, you don't want to depend on IT. You want to change your processes on your own. Systems should have that ability for you to do it on your own rather than depending on IT or whatever. So I would say I want to change this 18 months to 12 months or even 24 months. I can actually do that. So I'll probably change mine to just 12, just to show you as an example. I'll then update this, and I will then go back into my process here immediately for you to see how that would work. So if I go into my rolling forecast now, you'll see I'm looking at 12 months instead of 18 months, right? And continue my process. And this is when the monitoring piece is important, and it comes back to this. So I'm going into my profit and loss in here to set two agendas. One is to show how that data will flow across. So you can now see that I have my data coming through. I have my budget, I have my rolling forecast, and I could also have a visual representation here to say, hey, I want to see how my revenue is doing on the next 24 months. So I have my budget. I can also see my rolling forecast and see how it's going. You can see the closer months. There's it seems to be the rolling forecast is performing much better, and the rolling forecast towards the rest of the year seems to be more conservative at this moment. But that's the process of this business, and that's how we planned it. But you can continue to monitor it as per your business environment, and you can have quick view immediately. Now, another thing which is important as part of my stuff is to actually look at it from a reporting angle, not just from numbers and all. From a finance point of view, numbers are great, but we should also have for the management to have quick management dashboard as well. And I will get your attention to the management dashboard here. So I have an example of a management dashboard in here. So I'm looking at my year's earnings, my cost, my profitability, also looking several parts of the business, not only but also from the cash flow side as well. How's my opening cash in hand, how much in balance, closing, opening, and also looking at in this business. So you have different cost centers, my shop floor and my packing and stuff like that. How is that impacting, and what is the total effect? So you can see how much that makes in terms of my revenue and my costing, and also movements of my expenses as opposed to my total revenue. Now, at this point of time, we can deep dive into certain KPIs, like especially in the finance side, you would like to see, hey, what about my liquidity ratio? What's my operating ratios? And can I deep dive into those ratios? So if I look at my liquidity ratios here, I could probably say I want to look at my debt equity ratio. I can see how that is performing. I can then accordingly comment. So in this case, I've already commented, but I could maybe change this based on how this moves along the way. So I have commentary options as part of that process itself here. So it really helps me and to do that for different KPIs as I require to do so. With that, I'll close this and now come back in here. Another aspect we talk about is risk management and risk monitoring, and that's also a key piece to it. And I will talk to an example here. I'm based in Melbourne, and you can see that you have different risk parameters here. And one of the things that I think is relevant in this climate now is that the COVID just hit, right? So last month, it was a rare occurrence, so there's no impact on my business. But now with COVID, there is a risk, and it could be severe in this case, and that's something I have to understand. Oh, by sales, from a retail standpoint, could be hit. People probably don't want to leave out. Do I then increase and improve my online presence? Do I give a promotion online? All those things can be monitored and constantly be reviewed across the different risk metrics that you're looking at, and then being able to tie it all together, right? So, and if this thing, I also would like to close this off, the reporting piece, with talk about efficiencies, right? Because end of the day, you're the Office of Finance, you're doing a lot of these things manually. You want to have your reporting packs, your P&L, your balance sheet, your cash flow, all should be automated ideally. So I would take this example of using a PowerPoint slide here. Instead of copying and pasting it, what you could update this stuff directly from the system. So if I bring this PowerPoint in here, I can see a Xerox ribbon in here. I can update the data live from there. So you can see our biker best. This is not biker best. This is another information. So I can actually update live information to see this data getting updated live right now. So you can actually see the data is taking effect right away. So it's actually updating all my data across my P&L, my balance sheet, my cash flow. And so I can immediately see how that will translate into my business. So you can see that the data has now been updated. I can see my this 2022. I can then see how this will affect my my P&L. It's live from there, and my balance sheet and my cash flow, right? So you don't have to copy paste it. You can just set it up once, and you can update that directly from the system. From that standpoint, I kind of tied all these key elements together. And then final piece, which I think is important, is to look at the what if. And with that, I will be able to, conclude. So you can see my what if in here. So I'm looking at different products. You can look at my demand. You can see that my statistical, predictive has given me base. Then says some adjustments, and then I'm doing my this is a production example. This would apply to different businesses where they do services as well, and apply different assumptions and drivers to be able to see how that will help. So in this case, I have it up. This is medical business, for example. So I can actually say, what if there's an expiry of those stuff? If this expiry increases, reduces by a certain amount, how will this affect, right? So maybe if it expires a lot more than I expected it to, how is that going to impact? I can see that there will be a shortfall now because of that, and that will impact my production units. I can look at my different, bill of materials, how the cost of that will impact my stuff. Could be at the logistical level. What if I'm shipping certain things? How will this affect? And so on and so forth. So there's a lot of things that could impact my business, and I constantly want to monitor this. So I have the option to have version modeling across different versions. I can plan it across different versions, compare it, copy across the versions, and see how this will apply as well. So it's a constant process, which, as Peter mentioned, it's a very important piece. Any systems you implement ideally should have the option for you to be able to do that constant process as you go along. At this point of time, I'd like to go back into my main screen and say, I hope I was able to help you connect the dots between what Peter spoke of and what how it would possibly work out in a system and help with your process. There's more from a Xerox standpoint that we could actually bring in the element of Excel, and how Excel, we all love Excel, and how we're able to do quick analysis within Excel and be able to, for example, in this case, transform a simple Excel like this into a complete Xerox model, then which becomes dynamic. I have a lot of such stuff to talk about, but in view of time, I will pause at this time. If we get an opportunity to catch up some other time, and where we could address your specific business issues, we're happy to deep dive into these kind of areas at a later time. And with that, I would now like to pass my time back to Ram. Thank you guys for sitting through my session.
Thank you very much for that, Jitu. Very insightful presentations by yourself and Peter earlier. For the audience, I'd like to suggest that you do please, if you have any questions to Jitu or Peter, please post them on the Q&A function. because we do have some time left as part of this webinar to be able to answer any questions you might have. Peter and Jito are at hand to do that. So let's wait for some of the questions to come through, and before we give the audience an opportunity to perhaps put some questions to you, Peter, perhaps if I could start off with a question. Is finance seen as a valuable business partner to all functions in your integrated business planning process? I mean, being a finance professional myself, I'd probably know the answer. I'd probably have an answer to that as yes, but maybe if you can provide some depth to that question and give some indication as to how important or how valuable finance is as part of that IBP process.
Well, certainly in the IBP process, they are indispensable. Ram, you know, you need the finance people involved in integrated business planning. But unfortunately, there are some organisations out there that maybe don't value the finance team as much, or don't integrate them as much. So the sales and marketing team and the operations teams get on and do what they need to do, and they call on finance if and when finance needs some numbers, but they aren't necessarily part of a completely integrated and collaborative approach to the way the business is managed. I've got lots of companies where I've implemented integrated business planning, but the finance team, corporate, global, regional, still ask different members in the organisation to give them their latest forecast, not realising that they should be part of integrated business planning and getting their numbers from that process. So yeah, definitely important people, but some organisations struggle to understand how they fit in, and sometimes some organisations actually think that finance runs the place, and so finance takes a higher profile. So it comes across in different manifestations.
Thank you for that, Peter. Jitu, did you have anything to add to that?
Yeah, I mean, I agree with Peter there, right? That's how it works.
Okay.
I mean, nothing much to add beyond that, I would say.
Okay, cool. Peter, perhaps another question whilst we're waiting for questions from the audience. As part of your presentation, you talked about aggregate before detail when you're going through your planning process.
Yes.
And a thought that occurred to me, when you're doing aggregate before detail, I mean, obviously they're both equally important in their own way.
Yes.
And would you go for a top-down approach or a bottom-up approach? How do you go about when you're looking at aggregate before detail?
Yeah, well, there's two elements to that, Ram. The aggregate for us is, and a lot of businesses, is important because particularly if you're looking out over a longer planning horizon, like a strategic plan, 5 years, strategic plans are usually done in annual buckets, aren't they? And you're looking at your business units, your business segments, categories, product groupings. And from there, you get, because you're forecasting or planning so far out into the future, you get a much more accurate feel as to what the business will look like if you operate at that level rather than at the detail. And in fact, the detail is important, and you could do the detail over the longer planning horizon, but it doesn't really add any value. It's a lot of work for very little benefit. But as you know, in the finance team, and if you speak to the operations people within the organisation, there comes a point in time where you say, well, great, it's great that we've done this aggregate planning and we've got a really confident feel about how much we could sell of this product group over the next 5 years or the next 2 years or whatever. But there comes a point in time where you do need the detail. If I'm in the supplier operations team, I need to be able to procure raw materials and packaging and production time, etc. So I need to know the detail. From you in a finance perspective, you're asking the questions about, well, how much are you going to sell that product for, and what is the actual cost of goods, and how much operating expense do we need to be able to run the business? So we can say, for argument's sake, we need $1 million for salaries but then at some point in time you have to get to the detail for that. Do I need to know my salary in 5 years' time? Not necessarily. Do I need to know my salary this year? Yes, I do. So it's weighing it up that way, Ron.
Yeah, that makes good sense. Thank you for that. Perhaps another question, in terms of the scenarios, do you prepare or update scenarios on a monthly basis with your functional colleagues to describe different future outcomes, or is it on a different time period, for example?
We would recommend on a monthly basis. I mean, you don't have to be reviewing all scenarios, but remember I talked about opportunities and vulnerabilities. So if you have some opportunities, you have to say, well, what do we need to do to bring those opportunities to fruition? And we don't have to make necessarily decisions on them straight away, because the opportunity could be due to materialize in the middle of next year. So when do I have to make the decision on that opportunity? I don't have to make that until March next year. Okay, so it gives us time to consider it. But if we did choose to exploit that opportunity, and if we were successful, what would our revenue and our volume and our profitability look like? And would we as an organization be able to handle that from a supply perspective? So we rely on the planning managers. Remember, I talked about that planning team. We rely on those planning managers being very skilled, capable people doing this scenario planning, working collaboratively together. Say, well, we need to work on this opportunity and this risk at the moment, but these we can delay for another 2 or 3 months. We don't necessarily have to build a scenario on them just yet. And as Jitu showed you, if you've got technology that can facilitate that, well, then you can record the opportunities and the risks, have them sitting in the system, and then you can play around with them on a monthly basis, which is not too onerous.
Yeah, I think the technology point you make is quite an important one, and I think that sort of permeates the entire presentation. You really need the help of technology, and Jitu, perhaps just a question for you in terms of the system that you demonstrated. I'm assuming this is the case, but I'm assuming that the data that the company holds will feed into that system automatically for you to be able to make all your predictions for the future.
Yeah, that's right, Ram. So that's where the data integration piece comes in, and that's and the businesses have multiple data sets sometimes, coming from the ERP, which could be SAP or Oracle, whatever, or also CRM systems like Salesforce and stuff. So it's important that whichever system you're dealing with should have those capabilities to be able to pull this data seamlessly in, and sometimes even out, because sometimes what happens is with customers who say, hey, I'm doing my planning in a particular system, but I need to have that budget back in my ERP to reconcile and everything to be in one place. So it should be a pull and push thing, and that's something, for example, Xerox supports for sure. But I would say any system people consider, I think these could be elements that they should take into account. Okay,
thank you for that. I think we've run out of time. We're just 1 minute away from 1 o'clock, Melbourne time, that is. So I take this opportunity to thank both of you, Peter Metcalf and Jitu Varghese, for your respective presentations. Very insightful, particularly given the situation that we are currently in. Financial resilience is obviously quite an important topic. So with that, I would thank you both for your time today, and I will pass back to the host to close the session. Thank you.
Thank you, Ram.
Thank you. Thank you, Ram.
Thank you, Ram, Peter, Jitu, and the team at Xerox, and thank you to everyone for your participation. In the next 3 working days, you will receive an evaluation survey accompanied by the recording of this webinar. We really appreciate your feedback, as it is extremely valuable to the CPA Australia to help us deliver better events for you. Thanks again, and we look forward to welcoming you to another CPA webinar soon.